Well, hey guys, so welcome to another week of Property Rants, UK Property Rants. So we've already got a couple of guys online, which is great, and we've got the comments up now, so we can actually, any comments you've got, send them through, and we're happy to answer them. Obviously, yeah, the more questions the better, and that, of course, there's lots of topics and things to be covered right now, lots of things to discuss. So yeah, tonight joined by, or today, I should say, middle of the day for... Well, it's actually 10:30 at night. I'm in Australia right now for Christmas. And then, so you guys are obviously in London, or London and Lincoln with Chris. So we've got Ritesh, and we've got Himanshu, and we've got Chris joining us this week. So Chris is heads up our lettings up in Lincoln, the department up there, so he can talk anything about property in terms of lettings. So we can, we might as well get started. Right, guys, so what are we going to talk about today? Lots to talk about. Should we, what do you reckon? Should we start off with the news that just come out, which is the lovely inflation stuff that's going on? And look at that. I just realised that we've got, it's not showing on the screen, is it? I need to move it over a little bit. There we go. Yeah, okay, good. Yeah. So basically the inflations have come out. The, largest inflation in 41 years, which is pretty full on. We're at 11.1% now for the year to date. Now that's over the entire year. So what's this? So we've already got a question, which is great. So Skazza says, why have the house prices not reflecting the rate rises yet, and when will they? So good. And I think the answer to that actually is pretty simple. There's always a delay. So, there's a stimulus and there's a response. And I think, that's what we're seeing right now. And this is with everything. I think we've got a number of different things, and we can talk through each of the reasons why. I think, look, you can read here and, talk about, the war in Ukraine, which I don't believe. I don't believe that game. But, rising energy bills will take effect. Obviously, everything is rising. I think we've all seen that across the board in all of our bills, that they're all rising now. And I think where are we? Let's move back here. And I think prices have definitely gone up. 11.1% over a year. They're saying 10.1% in that particular thing. But actually, if you go onto the government figures, the ONS, the Office of National Statistics, they say that it was in 9.1, I think it was. So it depends which stats you're reading, but we all know that all know that inflation is hitting us and going up, and it's probably going to be around for a little while longer, because obviously it doesn't. Whenever you make a decision, it doesn't fix it immediately. All right, there is a delay. So yeah. Any thoughts on inflation? How are you guys? Because you're actually living in the UK right now. You're seeing prices going up. I'm sure you guys don't do the shopping, but or do you? And,
well, I do, mate.
Do you? I don't. So, yeah, I don't really see it on a day-to-day basis. What about you guys?
Like you said, you do notice it very much on things like shopping, which I've taken total control over to make sure anything that's not required is chucked straight out of the trolley. But make sure that all my requirements are, the beers and that are in.
Yeah.
But everyone, we're all feeling the fact that inflation and the money that we're using on a weekly basis is not going as far as it used to. I don't think it's massive. Well, to me, it's not like I've been shocked by it, because it's been coming. Okay, yeah. The talk, about it it's been going on for months and months and months. Yeah. So unless someone was just putting their head in the sand, off the position, it's been coming. So not shocked by it. But I would like to go to that question put in here by Scars regarding why our house prices not reflecting the rate rises yet, and when will they? Now, I'm assuming what you mean here is that rates have gone up, but house prices haven't massively come down, is what I'm taking from this question. Anyone else reading it?
Yep, that's how I'm reading it too.
Yeah, cool. So look, my thoughts on that, are very much lag effect, of course. So anything that's done today, the effects of it, you feel a little bit further down the line. But going in a little bit deeper is, I think if everyone's sitting there and thinking the housing market, all across the UK is just going to crash and fall off the face of the earth, like some of the headlines would have you believe.
Hold on, I
I've
stuffed
read.
it. It's all right. I left some Arsu out. There we go. It's gone on the wrong bloody. Sorry, guys, my technical expertise is failing me. Hold on. Here we go. It's all right. Keep talking.
Yeah. So you're obviously going to have those big headlines of house prices going to drop by 20-30%. Ridiculous figures, which we're used to seeing whenever there's something major happening, whether it was Brexit, tax changes, COVID, and we all saw how house prices were meant to fall off the cliff in the UK, but none of it actually happened. So you've got to be very careful to obviously distinguish what actually is really going to happen and stay away from the scaremongering of the headlines. And what I think will happen is, look, I think there will be a correction for sure. I'm not. There will be a correction, but I don't think it will be a correction across the whole board, as in not the whole of the UK. I think it's going to very much come down to micro markets where some areas will actually come out of it pretty well. Where there'll be next to nothing, if any, correction. Some areas will fall off the face a little bit. Okay, but you'll actually find some areas, and this might sound like really, will steadily keep moving. I'm not saying it's going to shoot up massively. It will steadily keep moving, and that's what. So you've just got to get very, I suppose, local. You've got to decide. Okay, if I am going to invest in this market and take advantage of the opportunity, which no doubt will come along, then I'm going to take it. But I'm just going to make sure I'm sticking to very specific areas.
Yeah, and I think we saw this in the last recession. Everyone said, house prices are going to drop 30% and I'm not going to buy now, I'm not going to do this. And the challenge that you face is that if you're trying to buy in crappy areas, without the fundamentals and that sort of thing, then fine, wait around until it drops, and it probably will. But as we saw with London last recession, was yes, it come down, but within 6 months, in fact, it was more like 3 months, it was back up again, And so a lot of people were like, I missed the boat. And then, of course, the old procrastinator, it's too expensive now for me to get in. And the thing is, then they had, 6-7 years of it's too expensive. And, of course, now we've been sitting around with London, not doing a lot for through Brexit and through, tax changes and through COVID. And, of course, now I think we're ready to see London come back because, there is a lot of demand for it. There's a lot of money getting spent. So I think we've got to be... And I agree with you. We've got to get local. We've got to look at what areas we're actually investing in or wanting to invest in, because that actually determines whether you want to wait around or whether you want to start, getting involved now. Because developers' expectations and, sellers' expectations have started to drop. They're becoming more realistic pricing already, even though we've only just started to see it in the stats. And of course, this month we're hearing about how demand and asking prices has dropped. Well, that's the prequel to property prices dropping. So, to come back to the question there. But I guess, with property prices, you don't know how far they're going to go down. But the interesting thing is with that whole game is that what we have started to see is now where we're getting back and we're actually having, this one's, one of the largest chains today, 5% fall in London prices next year, but said the capital would avoid, a big crash. Major banks upbeat about the UK house price growth despite rising rates. So you're seeing a lot of this now where we're starting to get back into. It's almost like the doomsayers, and I don't think we haven't seen house price drops yet, really. Even though there is some reports and things like that that are saying it is. We haven't really seen them anywhere near where they're going to be. In some areas, I think they will get hammered because they haven't got fundamentals, And actually, to be fair, a lot of those places, we've seen 15% house growth or 11% house growth or whatever, but those places haven't seen that. They've remained dead still, and not done anything. But what about you, Hema? Is there any thoughts on the house pricing side?
Yeah, I was just going to say, I mean, Rick, obviously you speak to developers all the time, right? What's the sentiment from developers? Are they going to suddenly now start dropping their prices, or is it a case of, no, we know we're going to build to this spec, we know what kind of margins we need to make this profitable for ourselves, we're not willing to take a hit on that? What are you finding when you're speaking to developers?
Well, you would imagine my job when it comes to sourcing should have just become a lot easier. where I'm getting developers who are saying, "Yeah, Rick, here's a double-digit discounts and take it off our hands." The reality is, it's not there right now, because the majority of the developers that we deal with and I deal with are sort of medium to large size developers, because that's our market, to stay safe where possible. And what you find with a lot of them is that, look, they've forward sold a lot. Okay, so selling through the off-plan stages, so they've pretty much got completions that will carry on happening from sales that have happened over the last 3, 4, 5 years, will keep happening through the next couple of years. So that will sort of help them ride out the quiet downturn period. Things moving along. The second thing that's coming into play is the international market, guys, because. And it's sort of quite similar to what happened back in 2009. Whilst, I fully understand in the UK, there might be the uncertainties maybe holding people back from taking that step and buying property, whether it's for investment or moving home, whatever it is. But the opportunity for the international clients all of a sudden emerges where, for some of the pound sterling dropping off is almost like a 15-20% discount to buy UK. So because of the UK is a global market, and not just London, even the major cities like Manchester, Liverpool now, all these cities, people in the international countries want to buy there. So the sales for the developers, as much as they might not be as high as they are during times of certainty, they're still slowly trickling through. So two things: one, you've got forward selling, so they're just moving along. Number two, they've got international sales, because there's certainly an opportunity for internationals like there was back in 2008.
Yeah. It's interesting actually, because there's another sort of thing there where if you look at is it this one? Yeah, it's this one here. So you've got Persimmon, who basically are a developer. They're saying that their sales, there's a fall off, as obviously the market dips. So these are actual, the cancellation rate has risen sharply. And I think that's the other thing too, is right now they haven't they've started to see it, but they haven't really had it. They've been making good sales, there's been good demand, but as that slows down, but my question for all this too is that, and I guess I'll get your thoughts on this, is how much of that slowdown of those cancellations is due to recession, interest rate rises and things like that, war in Ukraine, that sort of stuff, and how much is actually due to the fact that we're now going into winter. People don't want to put 3 levels of coats on and their snow boots and walk out and go and look at 10 properties and things like that, which happens every year. And we see this this time every year. And then we see in March, it all starts to pick up again. April, by April, it should be, when we get the beautiful days, it'll all pick up again. I don't think it'll pick up as much. I think it will slow down, and it will probably stay slow next year as we go through, and we shed some jobs. We've seen a lot of the tech jobs being shedded, and FTSE's has dropped. All those sort of, in fact, all of the indices have dropped, and that there's not the availability of, and especially for like London, when you don't have the seed capital coming into a lot of these startups and these sort of companies, that's going to affect how many people they can hire, how many people they can leave on. They have to get, let go, and then they have to find other jobs, and that process takes about 2 years, But yeah, what's I guess, are you guys? Are we noticing that cancellation of sales? I think you said to me today, or was it yesterday? You said how you noticed that the availability of some of the developers, some of those plots started coming back on.
Yeah. So I'm sort of recently seen over the last sort of week or so where certain units which were sold off master price lists, which I have access to, seem to be coming back with a sort of WhatsApp from the developer saying, let me know if you've got a client who would be interested in this really good unit, happy to sell it at that price that we originally locked it in for. which is opportunity. Of course, it's opportunity. So there is a bit of that. But at the same time, I can talk also from the sales that we're making as a business, that are a couple of sales here and there, which have fallen off. We're not in a situation where we've got, all of a sudden 20 clients who had invested in a development who have all sort of changed their mind. I mean, one of the projects we've done in Birmingham, for example, if you remember, we got in so early that exchanges, they reserved in a totally different environment, effectively in May, because of the early entry point. By the time the contracts and everything was ready for exchange, just a week ago or 2 weeks ago, they started exchange.
Not long, that's right.
Yeah, and I'm not going to lie, I was sitting there thinking, the market is sort of in a bit of a period of uncertainty. So these 20 sales that happened in the space of a week, because that's the sort of project it was, our buyers are going to get nervous, our buyers are going to fall out, because let's be honest, that can happen. It's natural for that to happen. But each and every one of them stayed in it and exchanged. So,
but I mean, they did buy in at the base, and even the developer said that they wish they had launched at higher prices. So, they were sort of quids in already. In fact, I think they were about 20, 30, 40 grand in already, I believe. So, I mean, that was a nice little project. We won't say what it was, but it was good. But I think the other thing with that, part of the reason we're insulated a little bit from this is the type of clients we deal with are the type of clients, they've got money, they're out to build a portfolio, they've got busy, good careers, earning good income. And I think by focusing on that side of the market, because we used to focus on the broad-based market years ago. This is going back to 2000s and 2s, 3s, 4s, 5s, 6s. And I think the problem was when we hit the recession, a lot of clients suffered through that because they lost their jobs and things like that. A lot of our clients now, that's not our client base now, and it's not the type of property we're going after, where developers, regularly go bust and things like that. So I think it's a slightly different. I mean, look, developers do go bust, and now is the time when a lot of them are going bust because prices have gone up so much. Contractors are failing; they're not paying them. There's a whole range of things, and that's a whole backstory where I've got quite a few guys that I'm speaking to in the business, and I'm sure you guys do too, who have developers and contractors that have gone bust. They've just gone into liquidation, and unfortunately, that's happening more. We've seen the repossession rate. In fact, the repossession rate's going up. I don't have the latest data on there, but that's the sort of which. When you look at this is May 22, so this is the earliest. This is actually on the government website right now, the latest stuff. But you can see in May, 7 in Eastern Midlands, 4. That's not a lot. 95 properties are repossessed, across the UK in May. We'll see when the new data comes out, which I believe is due out pretty soon, to see where that gets to. It is increasing, definitely increasing. But 95, that's not a lot in a month, So, and I think hopefully we had the mortgage market review, which meant people couldn't borrow as much. They couldn't borrow the higher loan to values. They had to have the affordability. And so that should insulate us quite a bit from that. But actually one of the other topics I was going to talk about, which actually this is quite a good one as well, which is that really, and I'll just make sure, fixed rates are falling, which I guess when we sort of think about it, you sort of think, hold on a sec, no, rates are going up. Well, no, actually, what they're saying is that, the average 2-year fixed mortgage rate is 6.28. Says Moneyfacts. But all the major banks have reduced their things because the gilt yields have fallen back down, that's an important thing to look at. But I think, what effect do you think that has on the market and the confidence and that sort of thing?
The interest rates, the fixed product rates coming down. I mean, look, with property, when you've got liquidity in terms of the ability to borrow, and the cost of borrowing will always have a direct impact on the market, because that's what enables people to buy, prices to go up, and all that. So I think it's kind of early to say, but it's a good sign that after the Liz Truss mess, which sent everything crazy, some calm and some perspective has come back into the market as there's a little bit more confidence coming back. So hence those rates are going that way. I mean, look, I had a conversation with one of our sort of experienced mortgage brokers that pretty much knows that industry inside out, been around for a very long time, deals with all our tricky cases, not just the bog standard stuff. And he said, look, rates have come down, yes, and the expectation is, he goes, that next year, by the middle of next year, they should start stabilizing more and more. But also in conversation with underwriters and that world, he said that they are fully aware of how the rate increase is affecting buy-to-let investors, and they are actually in talks right now and working on ways to bring new products to the market, which keeps that industry moving and keeps buy-to-let going, because buy-to-let mortgages are a big part of the bank's books of making money. It's as simple as that.
Yeah. It's interesting because I always say it like this, is that, if you imagine this is the, zero, this is base rate, and then there's a margin for the banks. And what's actually happened is the rates went back down, here, and the margins actually stayed quite, large for the banks. So, the banks actually were on base rate trackers, a lot of them. So what happened was when the base rate went down, their margin was fixed. And so actually it meant they were getting less money, et cetera, et cetera, et cetera. But what actually happened now is they've now put it against standard variables, which meant they were able to charge more. As the base rate has gone up, that margin has stayed there. The problem is, if that gets too expensive where people can't afford it, then what they have to do is they've got to go, you know what, the only way we're going to sell more mortgages effectively is by dropping that margin. And I think what we're starting to see now is the base rate is taking up this. The margin's going to start getting squeezed. And as the margin gets squeezed, that will keep people buying, keep the turnover of funds. Because let's face it, as a lender, the only way you're making money is by turning funds over, by actually your loan book and the size of your loan book, and creating new loans. So that's what we're seeing now. I think we're going to start to see some of that, above that 6% mark, that starts to get a bit where people can't afford it, And, if you look at my book, the 3+1 plan, we talk about mortgage cost averaging at 6%. And the interesting thing is with the 6% is, for ages, heaps of people saying, oh, well, that no longer applies anymore. You might as well throw that out, that concept. And I'm like, no, that actually is a principle. It doesn't really change. And the interesting thing is now, yes, we had an extended period where interest rates are very low, and it was a great environment from that perspective. But now I think we're returning back to normality and what the market used to be, where interest rates could go above 6% and they could go below 6% at different phases of the market. But the mortgage cost average over the duration is about 6%, So it's just that we've forgotten, and, we're very good at forgetting these sort of things, So I think that's one of the keys is, we've got to just go back to the basics, back to the principles that, I wrote about in the 3+1 plan, and then we all speak about, because if we do that and we look at the 2-year cash flow, and if we have to put money aside on top of, I think if you're in places like London, years ago when we used to sell London properties, you would be selling it and you would have to say, if you want to get a high loan to value, an 85% and 90% mortgage, you're going to need to put, in some cases, it was £300 a month aside to fund that property, the shortfall in the property. Because when you do mortgage cost averaging, that's what you're going to have to do. Now, some of this period, obviously, it would come down below that, but that's what you do. And I think people have forgotten that used to be the market we lived in for many, many years, and perhaps we're going back there. Perhaps we're not. Perhaps we've got so much other debt and so much other stuff going on that actually we can't afford to have those higher interest rate mortgages. And if they do go too high, then things will really start to taper off, repossessions, and then people losing their jobs and all that sort of stuff. Then we start to get into deflationary, depression-y type comments, which, there's plenty of people talking about that now. I'm just not sure if that's where we're at. We'll see, I guess. So yeah.
But as mentioned last week, like we mentioned last week, Brett, as well. With rising inflation, rents go up as well, right? And we've seen that. I mean, Chris, that you work obviously in Easy Track and you're doing renewals and stuff, and I'm guessing you've obviously seen rents go up by 20-30% on last year.
Yep.
right?
Yep.
So that's obviously going to affect cash flows as well. And look, we always talk about buffers, and we've been talking about buffers forever, as you said. Look, we talk about putting 6% in for your interest rates and stuff like that. But that's all about making sure that you're cash flowing yourself properly. And again, I'm telling my clients now when I'm speaking to them, put in buffers with regards to your interest rates, and let's just work on worst case, 100, 150 pounds negative cash flow. So what does that mean? Let's set that aside for the next 2 years, so then you're able to cash flow yourself properly over the next 2 years. But let's also look at, your loan to value. Look, we're working on 75% loan to value, but worst case, let's work on 70%. Let's work on 65%. So you, as an investor, before you go in, you know how much money you're going to need as a worst case, because as with any investment, there is a risk. But our job, and as an investor's job, is to make sure they're able to mitigate that risk and putting in those structures, putting in those systems, and that's what we help them do.
Yeah, 100%. Yeah. The is the street? Are you guys looking fuzzy on your thing?
Yeah, a little bit.
Yeah, on my thing,
I thought it was the.
Yeah. Anyway, I don't know. It might be the stream.
Younger.
Anyway, I was just going to say. So we've got a comment here. Let me put the comments up here, which actually they've gone a little bit. They're a little bit haywire now. I need to make them a bit smaller. So yeah, that looks better. Yeah, cool. Okay. So just a comment. So the counterparty risk to banks is higher now, so that actually adjust to make their margins higher to reflect the outlook. Which I agree that would be in the perfect scenario. Banks would love to do that. But if that's going to cut their demand for their product and the competitiveness, that's not going to happen. So I get it, but it's a bit counterintuitive where actually, as the rate goes up, you can't afford to increase, as the risk goes up, you can't afford to increase the rate that much. You may be able to do it some, but at the end of the day, that's where you've got the actuaries sitting there going, well, actually, if we raise this much and we make this much margin, we need to do this. And I think that's where, when you start looking at that sort of things, I don't think we can go, banks can't say, well, actually, I've got a 3% margin now, and I'm going to make that a 4% margin because my risk is higher. I don't think that they can't do that, because all of a sudden, if you're out of step with the market, then you stop doing business. Now, actually, some companies will do that because, for instance, they've filled their loan book and maybe they haven't got more fresh money coming in, so they're actually just trying to lend it out at a higher rate because if somebody will take it, great. But generally what we find is as that rate gets pushed up, then the margin will come down, and and I'm not talking down to millimeters, but it'll start to come down. It'll start to sort of sit around that 6% mortgage cost average. It'll go higher above that, but then it'll also come down below that. So yeah. Any other thoughts on house prices? I was just going to say, so I've got one more article here, which it's an interesting thing, and this is what I find. So this is the article here. This is what I want to show you. So it's 10 regions where house prices are set to fall the most. House prices are set to fall the most. See list in full. Okay, great. Right. So we're expecting this is the future because it says set to fall the most. But then if we have a look down here that I've highlighted, data from house seller advice shows demand fell, in other words, has already fallen 15.4% in, I don't even know how to pronounce that, but anyway, yeah. So we've got that. So you're like, hold on a sec. Are they going to fall, or have they already fallen? Well, let's go down a bit further and see what these 10 places are. And here they are. And 10 regions where the biggest falls in property prices over the past year. And you kind of like, hold on a sec. So on the one hand, in Land Registry, east of England, we're there, and this is there. So it's just, you got to be really careful with stuff like this, what you read, and whether it actually, what it's actually telling you. Who's saying it, and what are they actually saying, I think. And that's where I find so many people, they don't actually read where these things are from. They just read the headline, and that's it. And that's where I find a lot of problems come because of that, So, yeah. What else have we got here?
It's like, I can't remember the actual name. This was it Money Week? It's a specific magazine.
Yeah, Money Week.
That always used to, and it was all about. It was driven towards the equities market.
Yeah.
So a lot of it was to get people investing in the equities market. So every single week, the headline would pretty much be negative property.
It was.
Negative property market. So, like you said, it depends on what you read and what their motivation is. You know, if it's someone pro this, then they're going to pull that down. But what I love about the UK market is, you know, we're not a new market. You know, there's so much data, historical data and trends.
Yeah.
So much historical data, so many trends that you can actually look at that data and look at that data through different parts. So include recessions in there, low interest rate, high interest rate. So, you know, put all the scenarios in there, and then you can see, you know, you zoom out and you can see how the property market performs through all those scenarios. Now, I'm not saying that history, and just because something has gone a certain way historically, there's 100% guarantee that the future will also go that way, but it'll give you a pretty good idea of the way things are going to go. So, you know, with that UK market, especially in times like this, you know, it's really important to forget the headlines, you know, and just go to the data, zoom out a little bit, look at the historical trends, and then make your decision on what you actually think is going to happen.
Yeah, 100%.
Yeah.
Yeah. So, I guess, you know, house prices, I mean, it's one of these things where who knows what the hell's going to happen with it, you know? It's, you know, it's an interesting thing is, I was looking at this article here, which basically, this is land registry data from gov.uk. So you can see average price of, hold on, let's not do the type of, we can do type of property, but so this is all types of property. You can see we've been growing. We had a bit of a stint here, you know, but the reality is that's been the trend since 2004. You know, we had a dip here, but pretty much we've had growth over there. If we come over here, and that's a yearly percentage of change. So we've really only had drops in house prices here and here, okay? And the good thing is we can do it by, you know, flats and houses and see, but one of the things about most of this data is you'll notice it doesn't really matter. The house, you know, the percentage drops aren't that much difference, you know, depending on what you look at, you know. So that's the other thing. The other thing is here, you know, by status, first-time buyers, owner-occupiers, you know. Even though the price they're buying at changes, actually the trend doesn't really change. And, you know, if you look at all the stats, you know, if you look at new build versus off-plan, new build versus existing, one of the interesting things is, you know, obviously new build on this chart, it's actually done really well since, you know, January or since 2020, you know, through COVID and after COVID. Part of that, I think, is, you know, it's a cycle. So second-hand properties do really well, and then what happens is it tends to be second-hand properties do really well, and then new build properties do really well. And that also depends on the areas too. But certainly there's been a lot of money. There's, you know, you've got build to rent, you've got developers really building a lot of property. I think that the real issue is they're not building enough property, and they still aren't building enough property. You know, plus you add government stuff-ups, knee-jerk reactions, stupid decisions that the industry tells them this is going to be the outcome. They ignore it, and then it's the outcome. And that's one of the reasons why rents have gone up, prices have gone up. You know, if you want to fix that, you've got to build more properties. But, of course, I've been in the UK marketplace since 2002 when the Barker report came out, I think it was in 2004, talking about how we needed 120,000, or I can't remember how many it was, so many years ago. And they've never really done that. They've never really exceeded. It was like, why did you spend all this money on the Barker report? And then not back it up. But I just don't think the government's really, you know, motivated to do much about that and solve it. Maybe they are now. Hopefully they are now. But we're not really seeing that, you know, that much. But yeah. What else is there? So let's have a look at some of the letting stuff that we've got. Because I think going along with that, we talked about, you know, the new build prices that are actually coming up faster than the established stuff. But one of the reasons is, now look, this article is about people are ignorant about EPC ratings, and to a large degree they are. If you ask most people what a A versus a G versus a C versus a D are, they're not going to be able to tell you. But the one thing that is changing, which is the story you're telling me, is that lenders are now starting to offer better deals for better rated properties. So that's actually playing straight into our hands. As you know, our forte is new build and off plan stuff, with high ratings. So which is great. But yeah, so it was. What are some of the examples of that? What are they doing?
So yeah, it was just I actually came across that because a friend of mine who's always looking at business opportunities said, he knows I work in property, so he said to me, Rick, surely this is a really good opportunity for a business where, if energy efficiency ratings are going to become that much of a big deal, then they're going to affect prices. Where properties which are energy efficient are going to be in more demand. Banks are going to lend more money on them, and that's Barclays are one of the banks, for example, who if you buy a new build property or something which is newly being done, so the energy efficiency ratings are at the high end, then they will lend LTV to versus if you're going to do something which isn't. And there was also another article, another lender which I can't remember at the top of my head, talking about also they will give better interest rates. I think it might be NatWest, but don't quote me on that. But yeah, NatWest. But either way, it's not. Forget whether it was Barclays, NatWest, whoever it was.
Yeah.
It's actually a theory that the way that the trend as that grows, because these mainstream banks start it, but that will start filtering down. And as a country, as a world, everyone is becoming more and more aware, more incentives out there to be, environmentally friendly and all these things. And energy efficiency is part of that. So if we're, jumping onto a trend like that, it is a smart move, in my opinion, because what you'll find then is that as it becomes the norm, more and more people will want to buy new build property or properties which are not really new, but they've been done up so all the energy ratings and efficiency ratings are very high, because ultimately that affects the values. And obviously from the rental side, Chris will know more about.
Yeah, that's it. And especially with the EPC ratings, to letter properties going up higher, so you're going to need a higher spec. You're going to need a grade C by 2025 in order to be able to let out your properties.
Yeah.
So if at this point, all the energy efficiency is there, it's going to be great for investors on new build properties.
And we're already seeing some of the I think we only have one property that's under I think it's under a C or a D. There's very few properties we have, because obviously we sell new build off plan, and we have, even though some of those new build off plans, I was just saying the other day, the first property I bought was 19 years ago, so it was new build back then, but I don't know how long I can claim it being new build, and that's a lot of our investors. I mean, amazingly, they're now coming to us saying, so Brett, I'm retiring or I'm retired, and now I'm thinking about my 3+1 plan. I've got my 10 properties. Shall I sell off half? What should I do? Because we've been going that long. It's almost ridiculous. I mean, I can't believe it. This sort of stuff on the side here, I don't know what's happened there, but yeah, when I joined this business, when I started this business, that certainly wasn't there. But I think the amazing thing is with the EPC side is most people have no idea, and really, as much as we have to serve it to them as part of the initial documents and all that sort of stuff, nobody really looks at it. Nobody really understands it. And that's what that article was about, just saying it's actually a failed marketing thing. And it's a bit like carbon credits. If you walk up to the average person in the street and say, hey, how are carbon credits saving the earth? And they'll be like, well, really, it'll be all gibberish and who knows. And, clearly somebody's making some money out of it. Has it really made the efficiency better? I don't think so. Will it? I don't know. I think the government, if they're going to do it, need to actually put some serious education and reasoning behind it. Have you got any thoughts on that, Chris?
Yeah, see, I think people are going to be they're going to educate themselves on it more and more, especially now because of the cost of living crisis going up. People are going to be looking at utility costs, and I think they are going to be looking at the EPC certificate on the property that they are renting or looking to rent. Because the higher it is, the cheaper in running costs it should be for them. So definitely, I think that tenants will become more and more savvy and educate themselves, and that instead of, like you say, just looking at it and not acknowledging it or understanding, I think they are very much going to be looking on that now. It's the type of property they're renting, And for investors that are looking to invest, I think that they'll also be looking at that from a developer's point of view, because that's going to be part of the unique selling point of renting out their flat, is that they're going to be the highest, energy rating that they can be, to help tenants save as much money as they can.
The interesting thing is how they're going to do that. They're already, they're already talking about how they haven't got enough housing stock. They're not building enough. And now they're going to say, well, anything below C, we're going to take out of the marketplace entirely. I love the concept, but I just think politically it's a good conversation to have. I just think it hasn't really. I mean, look, if lenders put some real money behind it and say we're going to lend, higher loan to values. Which obviously higher loan to values are more risky for them, but actually it doesn't cost them anymore. If anything, it makes them more money. But cheaper interest rates, that's really putting your money where your mouth is now, because now actually you can go, well, actually, if I can get 0.2, 0.5 something off my interest rate, now people are really going to stand up, But I don't think the government's really made they've said you've got to increase it, but only if it's up to £10,000, I think it is, or £5,000. But yeah.
So with that as well, do you think that the number of first-time buyers will increase as well if properties are starting to fall below the minimum rating? I mean, I don't know the details if EPCs have to be a certain category for a sale, on existing builds, existing properties.
One of the good things about being in new build and off plan is whenever a government wants to stimulate the economy and get things out of a recession, the best way to do that is to stimulate new build. Yeah. So, and new build by its very nature is going to be, the EPC rating is going to be higher, because you've got a lot of people sit there and say, oh, new build, they don't make them like they used to. I'd much rather an old period property. And I'm like, screw that, because when you talk, okay, it's got character. You know what? Some of the stuff that I think, the new stuff has got character too, and I guess it's the, old timer versus young kid. My kids think I'm old now, and I think there may be some of that. But to be fair, I'd much rather a new build property than a period property. Maybe that's just because I'm biased, because that's what the business sells. But to be fair, no, I'd much rather that. I hate the creaky floors. I hate all that sort of stuff, because all that just adds up to, And I mean, now it's going to add up to more cost with the utilities. It's, potentially I get a lower interest rate. So yeah, it makes sense. Yeah. We'll see, I guess. And, I think it's a failed marketing thing right now, but if they keep, if they make some incentive behind it, I guess, it could work quite well, so yeah. What about renters reform bill? Because it's an interesting one. Now I pulled this out mainly because, Minister says renters reform bill will be introduced during this parliament. All right. Oh, by the way, this is in October, a month ago, by Simon Clarke, who no longer exists. And as has happened all the way along with this renters reform bill, is that it just seems to be getting kicked back into touch. Now, they keep talking about it, and it hasn't gone off the table yet, because you've got guys like Shelter and Generation Rent and, London Renters Union, who are protesting in 5 different places outside of estate agents that are responsible for, raising rents. It's like, But anyway, yeah, I don't know. What's your thoughts on that, Chris?
It's a difficult one at the minute. I mean, Section 21 is, in my opinion, very vital for the lettings industry, because it's no fault eviction. That's what a Section 21 notice is. Yeah. Now, we only serve that really if a landlord is looking or needs to sell his property.
Yeah.
Or we'll accompany it when we serve a Section 8 notice when it gets a bit serious. If they're looking to abolish a Section 21, there needs to be a whole heap of things that need to be carried out first. Yeah. So looking, either down the legal system, I'm attending court on 21s at the minute, and the whole legal time and process is very drawn out. So that all needs to be looked at, streamlined. If you're taking out the Section 21 and the landlord does want to sell, currently in a Section 8 notice, there's no clause in there. So effectively, if we abolish the Section 21 now without reforming the Section 8, a landlord could never sell a property with a tenant in situ.
And one of the things that pisses me right now is they've in the rentals reform bill, they talk about they're going to abolish Section 21 to give tenants more security. Okay. Now, maybe other agencies are assholes, but I've never seen one of our landlords call me up and say, Brett, I just feel like evicting them. They've always got a genuine reason. And if they take away those genuine, and they're not talking about taking away those generations. So they're saying that we need to adapt it. So if they sell, they can have that. So actually, whether it's called a Section 21 or whatever they want to call it, I don't care as long as we've got the ability. My challenge is they keep talking about the stick side, which is take away the 21. They don't talk about what they're going to do to harden up and to make the process easier to evict tenants who refuse to pay, who just take the piss, who damage stuff, who antisocial behaviour, who all these things that go on where we're powerless. The courts don't really, function. They're not functioning. The police don't care. They'll go around and, have words with them. But even then, when you try and get them to, write a report that you could probably use against, in a judge, no, they won't. And then it's just ridiculous for me. And they haven't addressed the issue yet. And that's what pisses me about the whole Section 21 removal is that my fear is they're going to remove it and then they're going to try and sort out the mess they leave for after that. And the mess is going to cost landlords even more again and drive more landlords out and therefore drive rents up higher, because there's less properties available, which has happened every single time. You think these guys, excuse the French, idiots that run, they're politicians, they would learn their lesson. But you know what? Their motivation is not that, I guess. So their motivation is to get voted back in. So yeah.
Yeah. And like you say, the key one is that we will end up losing a lot of landlords if this Section 21 notice is abolished, in my opinion as well.
Especially if they don't replace it with something,
No.
Yeah.
Because again, it's then going tenant heavy, tenant's favour rather than the landlord's side. It's just not very even, which is, the challenge that we're facing.
Yeah, and it's such a pain in the ass right now because we spend so much time with rent arrears from tenants who just have chosen not to pay. It's not that they've got COVID, lost their jobs, anything like that. They're in a little bit of financial difficulty, spent too much out on the piss on Friday night, and rent's due on Monday, so I won't pay it. I didn't pay it 1 month. Oh, you know what? I just won't pay it the next month. Oh, I'm going to be moved out anyway. So now I'm 3 months. Then we have to, so 2 months. We send Section 8s and whatever else. And then it's 4 months to 6 months before we actually get into court. And then they give them 14 days. And then they go, well, actually, they call up and say, well, we haven't got anywhere to live. And the council says, well, don't move out until the bailiff turns up. Then it's, 4 weeks to get a bailiff.
You're looking at a year. You're looking at 12 months, if you're a Section 8, which is serious rent arrears.
Yeah, and that's the frustrating thing that we see is we see genuine landlords providing good quality homes, doing everything right, even going over and above, because a lot of them, rather than issuing a Section 8 after 2 months, which they should do and which I plead for them to do, they leave it and give them chance after chance after chance, and then they're 6 months in, it can be 13, 14, 15, 20,000, pounds that they're down. And do you think the tenants are going to pay that? Unfortunately, we've now got debt collectors involved where we're just giving the debt off to a debt collector and saying, listen, there's the debt, go, you can go after it. Because it's just, it's becoming too easy for tenants just to go, you're not going to chase me, So
I mean, the biggest thing for a landlord to do at the minute, and especially with the rent, with everything going up in price, just generally, is get insurance.
yeah,
You got to take out rent and legal insurance on your property. That's a given. That should be, the first thing you look at. Analogy I use with some of my landlords is you don't drive a car without car insurance. So why rent out a property without rent and legal insurance?
yeah,
And all this is you're safeguarding yourself with
yeah.
loss of rent and then your legal costs as well, up until the point
And
that you get that out.
and you're talking 20 to 30 pounds a month to pretty much cover yourself. Yeah, So Arsenal's just sent another good question. Here we go. Sorry. There's a bit of a delay on my mouse button. They're setting the scene for with red tape for institutional landlords over there. Thank you. You know what? You're right. I've said this for a while. Build to rent is all about handing over what was where mum and dads were getting their pensions from. They're now giving it over to the big institutional landlords and pension funds and things like that. And that's what build to rent is about. Make the tax changes. Everything is playing into institutional landlords taking over, running the market, and having that control. Unfortunately, what's the World Economic Forum one? You will own nothing and be happy for it. And that's kind of where this is heading. And my take on that is you need to fight as hard as you can to keep buying property, build your portfolio, because it is cyclical, And as much as now we seem to be taking, hits every day, actually that will turn around. And when it turns around, because understand this recession that we're going to go into, no matter how long it is, whether it's a 4-year Great Depression type, drops and things like that, which interesting, Great Depression, if you look at the stock market, dropped 4 years, so we had a 4-year period. So if that's the worst that was, we're already 1 year into that. So we've got maximum 3 years, could be a year left. We've already started shedding jobs. A lot of the jobs that were shed in the COVID times. So we're kind of in that period where the recession hit. When we come out of a recession, what happens to property? Boom. Yeah. So after the recession hits the boom. So the people that want to sell now are kind of selling at the worst time possible. Really, you should be holding on as tight as you can. And obviously, if you can't afford it, or you can't afford the change, then fine. You've got to get rid of it. You've got to shed some off. But at the end of this will be property prices increasing. Rents will continue to go up now. Then property prices will go up because obviously with rents going up, wages going up, what can happen now? Affordability gets better, and of course, house prices can go up. So that's the natural cycle of things, and we're just playing the natural cycle out like we do every other time. Have you guys got any thoughts on that, Ritesh, Himansu?
I just think, with that, that's why getting inflation under control is really, really big deal. Obviously, the Fed, Bank of England, it's almost like they're obsessed by it, and people might think, well, why are they obsessed with that? When there's so many other issues that that people need to deal with here and now, in terms of all sorts of things. But it's the silent thief, isn't it? Inflation, So because you can keep increasing wages, and you can only do it by so much, okay, before it's like, well, I can't afford to increase wages anymore, right? But inflation's always too high, then it doesn't matter. Whereas if you increase wages to where you can, and then get that inflation back down again, that's when that wage increase has an impact.
Yeah, and you're right, and the affordability is actually enhanced so that the property prices grow. Because actually, you're right. If inflation just keeps going up and wages keep going up, then there's actually no change. Apart from as an investor with debt, my mortgage drops. The real cost of or the real value of the debt of my mortgage drops, which is a good thing. And that's why stay focused on building a portfolio and getting more debt. I know that sounds terrible, but actually, the debt is the thing that inflates away, and there's a huge benefit in that for you. because as the property price increase, the debt against that, it might stay the same, but inflation is getting rid of that money for you, which is good. So just one other thing I was going to sort of an other article. So this is a good thing, yeah? So we've been talking about this ages, which is basically, so this is Felicity Bouchan, is it? I don't even know how to pronounce it. So she's not considering rent controls. Now this, excuse my French, dick, Sadiq Khan, Mayor of London, he's been holding, he held a conference about rent in London and didn't invite any agents, any landlord bodies, nobody. He invited Generation Rent and all the, those guys, and basically, it was almost like, let's get a few mates around the table and come up best ways that we can actually try and force this, out. But you know what? It's proven that it doesn't work anywhere ever. All it does, the backlash is huge, and then rents go up and renters lose. So he's just, he just has no idea. I don't know if, yeah. Anyway, don't get me started on him. But any thoughts on that? The rent controls?
Yeah, I'm glad it's not. I hope it's not happening.
Do yeah, sorry.
It's just because, again, for the landlords themselves, investors, costs are going up. So if you're going to cap a rent at a certain point, it's going to become, a non-business, sensitive thing to do.
Yeah.
So I'm completely for non-rent, non-rent controls.
Yeah. It does not make any sense. Do you know, it's interesting. So I've been doing some renewals the last few weeks. I've been jumping in to help out with the renewals, because what we try to do is bring all of our renewals forward that we need to do in November, because we didn't want to do renewals in November, because if we do them in November and they hand their notice in, then you end up having Christmas without a tenant. So we're trying to avoid that. So we'll pick them back up the first week of December, which means we're then first week in January if they give notice. But it's interesting because dealing with that, the great thing about the renewals process is you have the landlord on one side who wants to get the maximum rent, and you have the tenant who wants to get the lowest rent, and you've sort of got to try and find the happy balance. And there's ways and means that we do that. But it's interesting. One thing I love about our landlords, is that not one of our landlords has said, screw it, get rid of the tenant, I don't want the tenant. Every single landlord without fail that I've spoken to has said, I've said to them, look, we can get this, we can effectively get this as the rent. This is the rent that we can increase this. So there might be £100 difference or whatever, £50 difference or something like that. But in every case, the landlord said, no, I'd rather keep the tenant than lose them.
Yep.
Which, and for me, that's a testament to how we, how we train our landlords, but also, the type of people that we attract. But the stupid thing is, I don't think that's us. I think that is most landlords are of the same, because most people, they're decent people. Now, yes, there's the extremes. And I think the problem is with the Generation Rents and all these guys is that they deal in extremes, and they think that every landlord is an asshole who just wants to drive rents up and get the maximum rent. Now, the problem is for a lot of landlords right now, and actually all credit to a lot of our tenants as well, because when I chat to them, they're like, look, I understand that the tenants, the landlord's mortgage will have gone up, so they're understanding. So actually both sides are understanding. I think a lot of the media is hyping this stuff up, and it doesn't necessarily need to be like that, Amazing how many tenants will say, hey, I can afford to pay this much of an increase, but that's all I can afford. And then I'll go to the landlord, they'll go, fine, let's do that. Yeah. I've not had a single case where they've gone, nah, screw it, chuck them out, not interested. I want £300 extra, and they're only offering 150 or whatever it is. And actually, some of the areas rents have gone up dramatically, and still to this day, as much as people say things are slowing down, we put a property on the market. We get multiple viewings and multiple offers normally. Some of the areas, we're a bit more crappy areas, but yeah. Cool. What else do we need to chat about? Or are we done? I think, I think that's, I've got, there's nothing else I need to. Is there any more questions from the guys that are listening? We still got anyone on board? I can't see how many people we've got, unfortunately. But yeah. And actually, I don't know, because we're actually streaming across to 13 different social media channels and things like that. So, but anyway, we're here every week, 12:30 Wednesday. And yeah, by all means, join us, ask your questions, send us questions. We're happy to answer them. Jump on, send us notes on comments on social media, and we're happy to come back and answer them. But anything else from you guys?
No, I just, before we leave, just like to sort of tell everyone to make a note. Look, over the coming days, weeks, months, we're in that sort of period where, I call it turbulence. There's going to be like headlines coming out saying everything coming to an end, or all these sort of things, that they're going to be there. But I think it's very important, as if you're an existing investor or someone who's thinking of investing or whatever, is to just put a bit of perspective into things and always look sort of long term. I say long term with all investments, but especially property. You've got to look medium to long term, because we always say if you hold property for 5, 10, 15, 20 years time, most people will agree that it will be worth a lot more money than it is today. And the reality is, when you talk about 10, 15 years, regardless of whether you buy that property, when you do buy it, if it's a recession or economically really good times, or high interest rates, low interest rates, whatever it is, when you buy property and hold it for that long, you will feel all of those periods. Okay, It's just a case of where does it come in. But you just got to set yourself up from the beginning, expecting all these things to happen and hold through it. Then it will pretty much become irrelevant, because what you don't want to do is sit there trying to catch the bottom of the market, because you never will. Well, you might if you get lucky, but it won't be that you were so strategic. You just got lucky.
But you're exactly right. I never, I look at that property that I've had 19 years. When I bought that, there's no way I was thinking about owning that in 2022 or 2023. It just wasn't. It was so long ago, so ridiculously long ago. But the reality is, I've held it through 2 recessions. High interest rate, low interest rates, everything. I've held it through the whole lot. I've held it through leaks. I've held it through having to repaint the bathroom, repaint the whole house again. I've even had to, it turns out that I bought the wrong property. Well, no, the land registry stuffed up. The developer put the plans upside down and they registered the wrong one. So I've had to go change that. So I own the property that I own, But yeah, you would never have thought. But that's the amazing thing about a lot of our clients, is that they're probably in the same boat. They bought properties, some of them now 18 years ago, 2004, onwards, and they still own those properties now, which is just incredible. So you will own them through thick and thin, up and down, high interest rates, low interest rates, recession, non-recession. And sure, we all like to buy a property and see it grow massively, in the 3 months after we bought it. But hey, that's not reality in most cases, So yeah, no, cool guys. All right. Any final thoughts? No. Okay. Well, guys, thanks very much, and we'll see you again next week. Any questions come through? You can just send an email to webinars@gladfish.com, or actually, in fact, we can start using support@gladfish.com. Which is no problems. But yeah. All right, guys. Thank you very much, and we'll see you again next week. See you later.
Cool.
Bye.
Yeah.